A negative outlook was applied to the personal line segment in September of 2022, and the opinion remains unchanged. Initially, the change was driven by pressures faced within personal auto as erosion in both auto liability and auto physical damage escalated. However, the homeowner segment has also been challenged, so much so that the outlook for this specific segment was recently changed to negative. In the aggregate, operating performance for the personal lines composite deteriorated since 2020, with the collective combined ratio going from a 97.6 that year to 109.2 in 2022. Underwriting challenges continued into 2023. Of course, the low in 2020 was influenced by changes in driver behavior amid the pandemic, which has since returned to more normalized levels. The outlook reflects the ongoing deterioration in operating performance, influenced by rising loss cost severity amid inflationary pressures and longer repair times that impact both personal property and auto losses. Collectively, this translates to an elevated rate need for primary insurers, with a larger differential between actual versus indicated rate creating obstacles for carriers in the pursuit of rate adequacy, especially within more restrictive regulatory states. Further, elevated reinsurance costs compared to prior periods has prompted changes to retention and co-participations in property lines, influencing the level of retained losses. Higher reinsurance costs have also influenced the rate needed by primary carriers to offset compressed margins. Additionally, more active weather trends continue to compound these headwinds. We expect pressure to continue into 2024, especially given current macroeconomic conditions as well as the dynamic weather trends. However, despite challenges, carriers' risk-adjusted capitalization remains solid, though the capital cushion has eroded for some insurers. Improving investment yields from rising interest rates and an aggressive push for rate across the segment are expected to help operating volatility, especially as higher rates earn in. Insurers are also placing greater emphasis on improved cat risk management practices and appear to be accelerating technological enhancements that will strengthen price segmentation and risk selection. As is customary, we will also continue to monitor the reinsurance environment as the January renewal period approaches and what the potential impact that may have on risk exposure and operating results for carriers.